We're all human, we're all prone to suffer from certain biases, and that's just led by emotion and evolution, frankly. The main examples that people suffer as an investor are herding and overconfidence, and often those two things go together. You hear about what's done very well, your friends do it, your peer group does it, they've maybe bought crypto, or there's been peer-to-peer lending, and you don't want to miss out, so you follow the herd, and that often leads to poor experiences. Or there's an overconfidence that actually you're cleverer than the market, you've read the financial press, you understand what's happening, maybe geopolitically, and you think you can pick tomorrow's winners on that basis. And that's, again, very rarely the case, that markets are extremely well efficient and well informed. It's very hard to beat the market. We have loss aversion, and we have short-termism. So we feel losses more than we feel gains, and we concentrate on the short term too much. So we worry about what's happened very recently, recency bias, and we don't think about the long term. So we might feel pain that an investment has performed poorly in 6 to 12 months, maybe 2 years. We forget that actually over the last 5 years or 10 years, it's performed very well, and we can struggle to take a look at the long-term view. This time always feels different. It always feels worse, but actually when you expand out and look at the bigger picture, that's very rarely the case. Emotions play a huge part in your decision-making process, and they often lead to what we describe as the big mistake, so an events from which it's very difficult to recover from, or from which you never recover from. So in times when markets are falling, there's panic, maybe the news, the financial press is all about how it's going to collapse this time, banks are going to collapse, oil's going to run out, whatever the crisis might be, that people start worrying that their money's going to run out, and they therefore take market risk off the table and limit their potential for future returns, which can devastate their long-term financial plans. The best chance you give yourself for success is by having an independent, objective financial coach to get you through times of stress, to keep you on track, to help you look at the bigger picture, to keep you focused on what's important and what the time frame is. If things look bad at the moment, you've got maybe 15, 20, 25 years to allow things to recover without it having an impact on you. You need to stay in the game, have the long-term plan and be able to stick to it. That's the fundamental reason for success in investing. The best way of describing behavioural coaching is someone stopping you doing stupid stuff. It's easy to make poor decisions at times of stress and you've got behavioural biases in place. You need someone to be able to look at it objectively and stop you making those big mistakes.